Bitcoin is on track to record its worst November performance since 2019, currently down approximately 17% for the month and trading around $91,500. While the price action has been painful, the on-chain data tells a story that is far more nuanced than a simple bearish breakdown. Over the last 30 days, Bitcoin whales have deposited roughly $7.5 billion worth of BTC onto Binance alone. According to CryptoQuant, this is the highest volume of large holder inflows to the exchange in the past 12 months. For context, we observed a very similar pattern in March 2025, when heavy whale transfers preceded a rapid drop from $102,000 to the low 70,000s. Those deposits were eventually absorbed, but not before creating significant short-term selling pressure. The question everyone is asking is obvious. Are these whales preparing to sell into the current weakness, or are they simply repositioning and managing risk ahead of year-end? History shows both outcomes are possible, but the persistence of these flows tells us that downside risk has not been fully removed from the table. That said, several counter-signals are beginning to emerge. First, retail spot demand is returning. Data from Crypto's Rus shows that small wallet and large wallet spot order flow are both increasing in the same direction for the first time in weeks. Bitcoin ETF flows have flipped from consistent outflows to neutral or marginally positive, and the cumulative volume delta is flattening. Second, global liquidity is expanding again. The Global Liquidity Index, which has an extremely strong historical correlation with Bitcoin's price, bottomed recently and has started to climb this week, the same week Bitcoin put in its local low near $90,000. Third, institutional adoption continues unabated. Nasdaq-listed Hilbert Group has formally begun building a corporate Bitcoin treasury, accumulating at an average price of $84,568 with the explicit goal of generating yield on those holdings. The Kingdom of Bhutan just staked another 320 ETH and confirmed it will migrate its national digital identity system to Ethereum in early 2026. LVRG Research Director Nick Ruck put it well when he said that the current pullback has cleared over-leveraged participants and unsustainable projects from the market. In other words, the weakness is doing some of the necessary housekeeping before the next leg higher. From a technical perspective, the monthly close is now critical. A print above $93,000, ideally above $93,400, would keep the higher timeframe structure intact and likely trigger a fast move toward $100,000. Failure to reclaim that level keeps the risk tilted lower into December. We are at an inflection point. Heavy whale deposits and lingering liquidation risk on one side, improving liquidity, returning retail demand, and disciplined institutional accumulation on the other. The next 7 to 10 days will likely determine whether November 2025 ends as a devastating capitulation month, or simply a healthy and much-needed reset before the final rally of the year. If you found this analysis useful, please consider giving the video a like, dropping your thoughts in the comments, and subscribing for daily market updates. Thank you for watching, and I'll see you in the next one.